Hey everyone, welcome back to the channel. My name is Nate, and in this video, I'm going to share 5 investments that I'm holding for life. And I haven't made a video like this in quite a while. I tend not to talk about too many personal investments that I make, but because the demand was there, we thought, let's make this video here today and share with you some of these investments that I'm holding for life, and maybe you want to consider as well. Now, a couple of quick disclaimers here. I'm just a random guy on the internet. I'm not a financial advisor, so don't take this as advice, just use it for entertainment purposes. I don't know, okay? That doesn't matter. And also, I think we're gonna hit 1 million subscribers sometime this week, so if you haven't subscribed already and you wanna help push us over the edge, I would really appreciate that. Okay, so let's get started here with these different types of investments. But I first wanna preface this with some of the things that we take into consideration here when I think about investments that I might wanna hold for 20 or 30 or 40 years. One of them is the potential longevity of certain industries or companies. So what you're gonna find is that these 5 different types of investments, it's probably going to be comprised mostly of different types of funds, like exchange traded funds or mutual funds. We'll explain that in just a minute here. And it's not so much speculative penny stocks or companies that I think are going to go to the moon tomorrow or something. It's more so companies that I see a lot of long-term growth potential with. But of course, like I said, I'm not an advisor, okay? I think we got that one cleared out. All right, so the first one that I'm invested into that I'm probably gonna hold for a pretty long time is the Vanguard Healthcare ETF. So the ticker for this is VHT, and there's a couple of reasons why I like investing into the healthcare industry. Now, I think some of these are pretty obvious, like the fact that healthcare is always going to be something pretty important to most people, but also, thinking about different types of industries, I think the healthcare industry has the best chance of surviving for a really long time, right? We think about the priorities in our lives, healthcare is certainly up there. I actually like investing into healthcare companies more than, say, energy companies, because I feel like there's less of this possibility of becoming totally decentralized with healthcare, if that makes sense. For example, if I'm investing into an energy ETF or an energy fund that owns a lot of different types of energy stocks, well, I don't really know where this is going in the future. I don't know how oil and gas companies are going to be looking in 20 or 30 years, but also it could be something that I could see being totally decentralized, where people just have their own solar panels and there's no massive energy companies that are sort of making money off of this. So this is why I think that the healthcare industry really has a lot of growth potential for it. But also, when I think about the aging population, not just of America, but of most of the world is getting older. And if we look at one of the largest demographics, it's baby boomers in America. Turns out baby boomers have some money. Not to say that I want baby boomers to have bad health. Of course, that's not the point there. But my point is that as baby boomers get older, they also have a lot of money. They're going to be spending a lot of money on healthcare. They're going to be opening up their wallets and making sure that they are in good health, which is going to cost money, whether it's physical therapy or different types of medicine. There's a lot of money in healthcare overall, and I can see that trend continuing in the future. And another reason why I like the healthcare industry and something like this Vanguard Healthcare ETF is because it does offer a decent amount of stability, because when you think about, for example, looking at last year, thinking about what happened with the recession and the economy, healthcare was still very prioritized on our list among everything else. And so some of these different companies that are within this Vanguard Healthcare Fund, you probably recognize companies like Johnson & Johnson and Pfizer and Merck, a lot of companies who made vaccines for COVID, but also a number of different biotech companies. And it's pretty made up of a lot of different companies, right? So we have over 400 companies that are within this ETF. An ETF is an exchange traded fund. It's basically just a big basket of stocks. If you're not familiar with that, I would suggest doing a quick Google search. But let's look at a couple of different criteria within this healthcare ETF. One of them being that the expense ratio is 0.1%, so it's 1/10 of 1%. This is what I would consider to be a very low expense ratio. You always want to take these into consideration when you are looking at different types of funds or investments that you are getting into. So with the 1/10 of a percent expense ratio, this means that if you had, say, $1,000 in this fund over the course of a year, you would probably be paying about 1/10 of a percent to Vanguard as their fee to basically make the fund for you and to manage the fund for you. So if you had $1,000 in that, it would probably cost you about $1 per year in order to run and operate that. So it's pretty low. When I see expense ratios over 0.5% or over 1%, that's when you start to think, is this really worth it? but 0.1% is relatively low. Let's take a look at overall performance over the past 10 years or so, and we can see that it's done pretty well since 2004. It has performed quite well, and just remember that past performance does not mean future performance. Just make sure you don't see something and say, oh well, this went up 20%, so it's going to go up 20% next year. That's really not how the stock market works. But overall, yeah, I really like the Vanguard Healthcare ETF. I think it has a lot of stability. It's something that I'm personally invested into, but please, if you invest into it, please invest at your own risk, because stocks go down, funds can go down. Don't think that you can't lose money. You certainly can, but it's something that I'm going to be holding for probably a couple of decades. And also, if you're wondering how to invest into some of these, like Vanguard, for example, if you don't have a Vanguard account, that's okay. Because this is an ETF, you can most likely buy this through almost any brokerage firm that you might have. Even if you're not in the United States, there are ways to get into this. So if you have Robinhood or M1 Finance or a variety of different other types of brokerage firms or whatever app you might be using to buy and sell stocks, you can probably buy this Vanguard ETF through there and some of the other ones that we mentioned as well. So just keep that in mind, because sometimes we'll be talking about Vanguard funds or Schwab funds, but you can probably find these on the market regardless of who actually puts that fund together. All right, so that leads us into the second one that I wanted to discuss here, which is investing into real estate. But look, I don't really want to be a landlord. I figured this out for myself that, I don't want to be somebody who actually owns properties. I don't want to have to deal with tenants, but also I don't want to have to deal with property managers. If I buy a property and then somebody else is running it and taking care of it, there's still things that come up, still things that I have to deal with. So I wanted to think about how I could get into real estate without actually having to own a physical property. And this is when I looked into something like the Vanguard Real Estate ETF. Now, you can get into REITs. This Vanguard ETF right here is VNQ. That's the ticker for it if you're interested in it. But I like having some exposure to real estate, and there's a few reasons for this. One is because real estate is very much a tangible asset, meaning that something that I really worry about a lot in the economy, especially in today's world, is inflation. And I think about the possibility of having hyperinflation. I think about the fact that more than 22% of US dollars were printed in 2020. Basically, what's happening right now in the economy is the government is saying, hey, let's make more stimulus packages. It's going to get us more approval, right? It doesn't matter, Democrats, Republicans, it doesn't really matter who you're looking at. When the government's pumping out money and they say, we're going to provide a $1.9 trillion stimulus package. Yeah, this is actually really much needed. Not to get too far into politics here, but yes, people need money, people need help. A lot of people are struggling because of the pandemic. But the problem is that we're basically just saying, hey, let's do a $1.9 trillion stimulus package and let's just pull it out of thin air. We're not saying, well, we need to balance the budget. We're not saying, well, to get this $1.9 trillion, maybe we should cut defense spending or cut different types of spending within the government. We're not doing that at all. We're just saying, let's just make more money. And so we're making more money, and the concern that I have is that holding cash, the US dollar, if I just had $1 million sitting in my bank account, I think in 10 years, that's going to be worth a hell of a lot less. So I went off on a little bit of a tangent there, but circling back here on how this affects you and me, this is why I like to invest in real estate or have some exposure to real estate, because I know that real estate will probably keep up with inflation. I shouldn't say that as a fact, but I hope that it keeps up with inflation. Historically, it has, because we're not making any more land and there's a lot more people coming onto this earth every day. And so that's the reason why I like to invest into real estate. Couple of different ways you can do this. For me, I just like to go for the Vanguard Real Estate ETF, but maybe you want to actually buy physical properties yourself and be a landlord. I have lots of friends who do that, especially good if you have some time on your hands too, and maybe you have a job, but you're looking for something extra to do on the side. This could be a great way. Or you could get into specific REITs. So REITs are real estate investment trusts, and you could get into specific REITs that focus more so on specific areas, right? You could buy a REIT for a company that is specifically focuses on maybe apartments in Texas or apartments in California or New York apartments, right? And so you can invest into those specific companies as well if you think those are going to boom or do really well long term. One thing that I will caution you on is, personally, I'm not too bullish on commercial real estate. I'm not really sure about where that's going to go in the future with office buildings and even with retail. So I try to focus on some type of residential real estate. People always need a roof over their head. They always need a place to sleep. And so for me, that provides some level of stability. This Vanguard real estate ETF, though, does hold a number of different types of real estate. So they own residential. They have a lot of different REITs within this ETF, but it gives you a broad sort of way to invest into something like that. And the expense ratio on it is 0.12%. So also what I would consider to be a very low expense ratio. So the fees on it are pretty low. And once again, you can buy this on Robinhood or anywhere else that you think about wanting to invest into it. Okay, so we talked about some of these different Vanguard funds. Let me switch it up a little bit and share the next one with you, which is a great way to get a lot of exposure to the 1,000 largest companies in America that are publicly traded, which is the Schwab 1000 fund. Okay, so this is probably my favorite one, and I think actually thinking about my portfolio, this is probably the largest one that I own. Once again, you don't need to have a Schwab account in order to invest into the Schwab 1000 index fund, but this is the 1,000 largest US companies, and you can see here that it covers approximately 90% or more of the total US stock market cap. So I feel pretty safe being in something like this. Of course, there are times when this fund goes down, right? If you look at it back in March, it went down just like the rest of the stock market did back in March of 2020. So this is something that, of course, I'm holding for a very long period of time. Let's just take a look at their top 10 holdings within this fund. It's Apple, Microsoft, Amazon, Facebook, Tesla, Alphabet, which is essentially Google and all of their holdings, Berkshire Hathaway, which is a company that Warren Buffett is running, and then Johnson & Johnson, which is obviously medical, and then JP Morgan Chase. So they do own, or they are kind of having hands in a lot of different types of companies throughout America, but this gives us an overall just kind of broad way to invest into America, into American companies. But let's say that maybe you don't have too much of a bullish feeling about American companies. Maybe you think that America is on the downfall and there's not a lot of growth left in America. I don't know. I'm sort of on the fence. I think there's still room for growth, but regardless, maybe you don't want to be so exposed to American companies. Sometimes I get that feeling, and so more so lately, I've actually been shifting outside of American investments and looking for some ones in emerging markets in different parts of the world. And so that's why the next one that I'm going to share with you is what is known as the Vanguard Emerging Markets ETF. So this, the ticker for this is VWO, and this is going to hold a lot of companies from different areas in the world like China, Brazil, Taiwan, and South Africa. So a ton of different areas. This is what would be known as an international or global ETF, and the expense ratio on this is 0.1%. So once again, very low. I like Vanguard funds, as you probably know. But let's take a look at some of the different holdings that this ETF owns. And so you might notice some of these companies and you might recognize them, especially looking at their top 10 holdings here, like Alibaba, and maybe you recognize JD.com or NIO, which is a popular stock that a lot of people have been investing into. So just looking at this right here, you can see probably a good amount of these are actually based in China, but there are other ones within here as well. So this fund is comprised of 5,048 different stocks. It's one of the largest, most diversified ETFs that I've seen out there. Most other ETFs that I'm investing into might have 400 companies or 500 companies, but this one has over 5,000, which is a lot, which has both good and bad. The good thing about a fund that holds 5,000 different companies is that maybe there's some companies within there that can really boom and really take off and be the next Amazon. But the problem is there's also going to be kind of crap companies in there as well that might be mixed in the bag. So this is why it gives us a lot of exposure, but it gives us some level of stability. Historically, though, you know, these emerging markets actually haven't been performing as well as some different US ETFs that I've seen in the past 10 or 15 years. But nonetheless, I still think that there's a lot of room for growth for the next couple of decades, especially in areas where maybe their GDP per capita is still 1/3 of America's, and they still have a lot of room to run to catch up to the GDP per capita in some of those countries. And so maybe their growth rate is a lot faster, right? Look at a place like India, for example, where their growth rate seems to be a lot faster with their GDP growth. Same for a lot of other areas within Asia and Africa as well. Their GDP growth can be a lot faster, growing, accelerating a lot more than maybe some more, I guess we could say, developed countries like in America or the United Kingdom, where it's almost not been stagnating, but not growing as quickly in some of those countries. Okay, so the last one that I want to mention here, it's going to be pretty brief because it's not my favorite, but maybe for people who want to be a lot more risk averse and they're worried about maybe valuations of certain companies, we have something like the Vanguard Total Bond Market ETF. The ticker for this is BND. And as you can see, I'm kind of a fan of Vanguard funds. I don't buy them through Vanguard, but I still get the Vanguard funds. This isn't my favorite, but I still wanted to include it on this list because, like I said, not everybody wants to be exposed so much to stocks, and maybe they want something that's seen as traditionally safer than the stock market, which is bonds. Now, bonds have not been a favorite for most investors in the past couple of years, and this is because yields on these bonds have been pretty low. I mean, sometimes these yields can be below 1%, so it's really not that attractive, especially when I factor in the fact that, you know, if you're getting a 1% yield on certain types of bonds, but they also have the risk of defaulting on those loans, is it really even worth that 1% when you average it out, especially when you get some of these different bond market ETFs? When some of these companies fail and they can't pay, then you end up losing money, right? You don't get your money back. Look what happened with Puerto Rico back, I forget what year that was, when they defaulted on a lot of loans. And so it happens. So don't just think that bonds are totally safe. It's one of the biggest misconceptions that people have, thinking that bonds are guaranteed money, that it's safer than stocks. It's not always safer. It depends on who's issuing this bond, right? Is it Apple? Is it a company that is highly reputable? Or is it something, you know, like some company that's a small cap company? They're a little bit risky, because if they're issuing a bond, the yield better be a lot higher than a company like Apple, or I think actually ExxonMobil has one of the highest credit ratings as well. But this actual Vanguard Total Bond Market ETF is comprised mostly actually of government bonds. So this is probably just what I would say is like a kind of a safe bet if you want to just park some money in there, but you're not going to really see a lot of growth in this. I mean, it's kind of almost fixed. Like if you are getting a bond for a 2% yield, you know you're not going to be getting more than 2% on that, and kind of worst case scenario, you can end up losing a lot of that money. So I actually am not really sure why I included it in this video, but I think it's mostly because I know there's a lot of people who maybe are in their 50s who are watching this video and they want to play it safe, because stock valuations are pretty lofty right now. Let me just show you the Shiller PE again, just to show you that valuations are getting pretty crazy. A lot of people are buying on margin. You guys have been hearing me talk about this a lot. Just be careful with investing in individual stocks, especially penny stocks. Please don't just go and watch like TikToks and then dump your life savings into some random penny stock or some random NFT or something else like that. So, thanks for watching the video. I appreciate it. And if you found any value in it, make sure you drop a like, subscribe to the channel, and let me know what video you want to see next. If you like these 5 different investments that I personally am in, and I'll see everybody in next week's video.